Welcome to the debate. So back in February of 2026, we saw roughly what, $285 billion of B2B software market capitalization just evaporate. And that was in just 48 hours.
Right, a completely massive, unprecedented wipeout.
Exactly. And it wasn't because of a macroeconomic recession, and it wasn't because of some massive accounting scandal either. It evaporated because one single company released an autonomous AI agent that basically proved human beings might no longer need to buy software seats.
Yeah, the Anthropic Claude Cowork launch. That was the absolute catalyst for the panic.
Right, exactly. And by mid-March, that localized panic had erased $2 trillion in software market cap. I mean, I really want you to think about the sheer scale of that number. We are looking at a $1.44 trillion enterprise software market this year.
Which is massive.
Andreessen famously declared that, software is eating the world. By every metric, he was right. Software completely won the game.
Oh, absolutely.
But the existential question now facing software CEOs, boards of directors, and, institutional investors, is what happens when the category that did the eating is itself being redesigned, and more importantly, repriced from the foundation up.
Right, which brings us to the core of what we're arguing today. Are we witnessing a permanent structural reset from traditional B2B SaaS to an entirely new AI-native business model? One that, frankly, permanently destroys the sacred 88% gross margin standard we're all used to.
Or on the flip side, is this just a cyclical transitional feature cycle where dropping compute costs will eventually, rescue those traditional SaaS economics? I am taking the position that this is a structural, totally irreversible reset. The first growth curve of SaaS is completely over, requiring a total operational teardown to survive a new 60 to 70% gross margin reality.
And I take the opposing view. I argue that declaring the death of the traditional 80-margin SaaS model is a massive overreaction. It misreads the historical trajectory of technological scaling. I mean, plummeting inference costs will ultimately stabilize the underlying recurring revenue model we've known for 2 decades.
Okay, well, let me lay out the foundation for why I believe the structural reset is unavoidable. The first growth curve of modern enterprise software, which basically spanned the last 20 years, was defined by a very specific economic trade.
The shift to the cloud, right?
Exactly. You replaced a $5 million on-premise software installation, one that took 2 years to stand up, required literal heavy server racks in a basement, an army of IT consultants. You replaced all that with a multi-tenant cloud service.
A service that took maybe 30 days to deploy.
Right. 30 days to deploy and a build on a predictable per-seat basis. The margins on that model were extraordinary. They often hovered around 80 or even 85%, simply because serving that marginal user was practically free. You were just renting out space in a database.
True, the marginal cost of a new user was essentially zero.
But that era is completely finished. By late 2025, we saw the median public SaaS revenue growth rate completely collapse to 12.2%. Valuation multiples imploded to 6.4 times annual recurring revenue, which is, it's a decade-plus low.
Yeah, it's been a brutal market repricing, no doubt about that.
Now, a lot of C-suites are trying to comfort themselves by saying this is just, post-pandemic digestion, or simply a reaction to a higher interest rate environment where capital just isn't free anymore. But the math doesn't lie.
Well, I think the math requires context.
But the fundamental economics have broken on the cost line. Inference, the actual computing power required to run these AI models, is not free. We are seeing average AI product gross margins sitting at 52% right now, with inference alone consuming roughly 23% of total revenue.
I come at it from a different way. I hear the panic in those numbers, and the market reaction in February certainly reflects that anxiety. But I think we really need to zoom out and look at the actual trajectory of the technology itself.
You mean the hardware scaling?
Yes, exactly. We are essentially judging a marathon by the heart rate of the runner in the first 5 minutes. Claiming that the 80% margin model is permanently dead fundamentally ignores how technological scaling works in practice.
I mean, 52% margins speak for themselves.
But let's look at the reality a CEO actually faces when they sit down with their engineering leads to plan their infrastructure costs. The cost of inference, the price you pay per token to get an AI model to think, reason, and generate an output has absolutely plummeted.
Sure, it's dropping, but
We're talking about an order of magnitude drop in just 3 years. We went from $20 per million tokens for GPT-4 class capabilities down to just 40 cents per million tokens, according to the Introl 26 data. That is a staggering deflationary curve.
40 cents is cheaper, yes, but it's still a real cost.
So yes, while current margins are highly compressed right now, because companies are frantically absorbing massive AI features into their core products just to stay competitive, this cheaper inference is a margin rescue in the making. We are in a profound feature cycle, undoubtedly. But treating a temporary COGS spike as a permanent paradigm shift is a fundamental mistake.
Okay, let me stop you right there, because I'm struggling with the math on this, and I think a lot of product managers and CFOs listening to this are struggling with it too.
Okay, break it down for me.
If inference costs drop from $20 to 40 cents, as you just pointed out, my immediate instinct is that my gross margin should skyrocket back up. I should be pocketing that massive difference. Why doesn't it?
Well, because it takes time to flow through the P&L.
No. Let's look at the January 2026 iConnect data. This is real, hard data from scaling stage AI B2B companies. They are seeing average gross margins of 52%. Compare that to the historical SaaS benchmark of 80%.
Right, the 28-point drop.
Exactly. That drop is heavily, almost entirely, dragged down by inference costs, which are taking up 23% of total revenue. To understand why this is catastrophic, we really have to look at the mechanics of the Rule of 40, which has been the golden metric for software valuation for years.
Sure, growth plus profit margin equals 40.
Right. For those who might just track the high-level metrics, the Rule of 40 is the idea that a software company's growth rate plus its profit margin should equal 40% or more. The entire financial architecture of these companies was built on an 80-point gross margin assumption.
I agree that the math was built for a different era.
If you have a SaaS company growing at 25% with an 80% gross margin, a Backham's framework shows they historically scored a 105 on the Rule of 40 metric. It's an elite, incredibly healthy business. But you take that exact same company, keep the top-line growth at 25%, but drop the gross margin to 67%.
Which is a realistic near-term floor, yes.
Right, which is what happens when you introduce these heavy, compute-intensive AI capabilities. That score drops to a 92. The entire math of how many sales reps you can hire, how much you can spend on customer acquisition, how much you allocate to professional services, it all completely breaks.
You're looking at a snapshot in time, though.
You can't just absorb a 13 to 28-point hit to your gross margin and pretend your operating model is still viable just because token costs are theoretically dropping on the back end.
But the physics of the tech tell a completely different story. We need to separate this snapshot from the structural reality. That iconic data you're citing, it's completely accurate for January 2026. I don't dispute the numbers at all.
Because they're the reality of the market right now.
But it represents companies that are awkwardly grafting massive resource-heavy AI models onto legacy architectures. It is the very definition of a transitional inefficiency. When you look at the Introl data showing costs dropping to 40 cents per million tokens, you have to ask yourself, how long does that 23% revenue drag actually last?
I'd argue it lasts forever because the product changed.
CEOs and technical founders understand Moore's law. They understand algorithmic efficiency. We are seeing quantization techniques, smaller specialized models, and massive investments in custom silicon driving the actual compute requirements down exponentially. What you are calling a permanent break in the cost line is actually just the infrastructure scaling phase.
Hold on, before we move past that, let's actually unpack these technical mitigations you just mentioned. Because to a board member or a CFO, things like quantization and specialized models just sound like tech magic that engineers promise will eventually fix the balance sheet.
It's not magic, though.
Well, how does shrinking the precision of a model's weights physically save on the AWS bill? Let's make this tangible for the non-engineers in the room.
Absolutely. Let's break it down because it is basic computer science. Think of a massive AI model like a high-end restaurant recipe that requires measurements down to the microgram. In computing terms, these are high-precision floating point numbers, like a 32-bit float.
Okay, so a very heavy recipe.
Exactly. It takes a massive amount of memory and computational power, meaning expensive GPUs running very hot, to calculate those hyper-precise numbers every single time a user asks a question. Quantization is essentially saying, we don't need to measure to the microgram to bake this cake. We can just use whole grams.
You just round the numbers off?
Essentially, yes. You reduce the precision of the numbers in the model from 32-bit down to 8-bit or even 4-bit. And the amazing thing about neural networks is that the output, the taste of the cake, so to speak, remains virtually identical for 99% of B2B use cases.
But the compute load drops.
It drops off a cliff. The processor works infinitely faster, it requires significantly less RAM, and it uses a fraction of the electricity. That directly translates to a massive reduction in the cloud bill.
Okay, I follow the logic of quantization, making the individual calculation cheaper. But what about the models themselves? They are getting massively larger.
That's the second piece of the puzzle. We are moving away from brute force reliance on massive models like GPT-4 for every tiny task. What engineering teams are doing now is intelligent model routing.
Meaning sending different tasks to different models?
Exactly. If a user asks the software to simply summarize a 3-paragraph email, you don't need a trillion-parameter model to do that. You route that request to a highly specialized, quantized, tiny, open-source model that costs practically zero compute.
And you save the big model for the hard stuff.
Right. You only route to the expensive, massive models when the user asks for complex, multi-step reasoning. Furthermore, we are seeing architectural shifts like state space models or SSMs.
How do those differ from the standard transformers everyone uses?
Well, unlike traditional transformers, which have a quadratic compute penalty, meaning if you double the size of the document they are reading, the compute cost quadruples, SSMs process information much more efficiently without that exponential cost explosion.
Okay, so the underlying tech is getting vastly more efficient.
Yes. So when you combine quantitation, intelligent model routing, and new architectures like SSMs, that 52% margin you cited is the absolute floor. It is not the ceiling. As engineering teams learn to optimize these agentic workflows, those margins will inevitably climb back up into the 70s.
Which is what? Healthy enough for a SaaS company?
It's plenty healthy for a high-growth SaaS business. Just like the early days of the cloud, when companies spent exorbitantly on AWS before they learned how to optimize their instances and auto-scale their compute. This COGS spike is temporary. It's the toll you pay to cross the bridge into the AI era, not the permanent cost of living there.
I hear you. And honestly, the technical advancements in quantization and state space models are undeniably impressive. But your entire premise assumes that the demand for capability remains static.
How so?
Well, it's a fundamental misunderstanding of the market dynamics and human psychology at play here. If inference gets cheaper, you seem to believe the company just pockets the difference. The AWS bill drops, and margins happily return to 80%.
Yes, that's exactly how margin expansion works when COGS drop.
But that is not what is actually happening in the real world. Customer expectations of capability have completely absorbed those savings. It's Jevons paradox in action.
Okay, remind me of Jevons paradox.
For the listeners who might not be familiar, Jevons paradox is an economic principle from the 19th century. William Stanley Jevons observed that when technological improvements increased the efficiency of coal use, coal consumption actually skyrocketed rather than dropping.
Right, making a resource cheaper only increases its consumption.
Exactly. Think about when long-distance phone calls became virtually free with VoIP and internet calling. People didn't just make the exact same amount of calls and save the money, right? They started calling everyone, all the time, leaving video connections open for hours.
Sure, usage explodes when the marginal cost drops to near zero.
And the exact same thing is happening with AI inference. If inference drops from $20 to 40 cents, the customer doesn't just ask the AI to summarize a static one-page PDF document anymore. Because the tech is cheaper and more accessible, their expectations baseline shifts.
They want it to do more.
They want it to do everything. Now they demand complex, multi-step agentic tasks. They want the AI to read a 100-page document, cross-reference it with a live proprietary database, draft a response, check that response against historical legal precedents, and then autonomously execute a workflow across 3 different external platforms.
Okay, but
Let me just finish the thought. The computational load per user increases exponentially precisely because the cost per token decreased. So, cheaper inference isn't a margin rescue at all. It is simply the baseline price of staying competitive in the market. The gross margin compression we are seeing isn't a temporary infrastructure spike, it is a permanent, structural reality because the product you are delivering is fundamentally different.
I understand the application of Jevons paradox here, and you are absolutely right that usage goes up. But usage going up is exactly what enterprise software vendors want, so long as it drives retention and creates upsell opportunities.
But it destroys the margin.
You're arguing that because the compute load increases, the margins can never recover. But that ignores the fact that as these agents become more capable, the software vendors are actively restructuring their back-end architectures to monetize that increased capability.
Monetize it how exactly?
If a customer is asking the AI to cross-reference 100-page documents and execute workflows across 3 platforms, the vendor isn't just going to give that away for free on a basic $20 a month subscription tier. They are going to introduce usage-based tiers or premium agentic add-ons.
But wait, if you're conceding that the base compute costs might be dropping, but the usage is scaling so aggressively that vendors have to introduce usage-based tiers, why wouldn't a company just pocket the margin on the base subscription?
Because they need to capture the value of the advanced features.
Right, which implies the nature of the product itself is changing. Which brings us to the inevitable consequence of this entire shift, the absolute death of the per-seat pricing model.
I think death is a very strong word for a pricing model that still dominates the Fortune 500.
It is a strong word, but it is mathematically justified. I mean, even if margins climb to the low 70s, which I highly doubt given the relentless capital incinerating arms race for model capability, you are still talking about a fundamental shift in the cost to serve.
The cost to serve is higher, yes.
If your cost to serve is deeply variable and inherently higher than the old simple multi-tenant database lookups, then the way you charge for that service must logically change to capture the value. You simply cannot have a highly variable, unpredictable cost structure paired with a rigid, flat-rate subscription pricing model.
You have to align price with value.
You will get crushed if you don't, and this is exactly what the market realized in February 2026. Let's revisit that $285 billion wipeout. When Anthropic launched Claude Cowork, they essentially demonstrated that AI agents could autonomously handle vast categories of administrative, analytical, and operational work that were previously sold as per-seat software to human workers.
It was a very impressive demo, certainly.
The market reaction was violent. This wasn't a general tech sell-off triggered by the Federal Reserve. This was a highly targeted repricing of a specific operating model.
I still think characterizing a market correction, even a $2 trillion one, as the permanent death of the seat is a classic Wall Street overreaction.
How so?
Public markets panic when they see disruption. They price in the worst-case scenario immediately. But a stock market sell-off doesn't mean the foundational business model inside enterprise IT departments is dead.
But the logic behind the panic is absolutely bulletproof. I want to introduce Jason Lemkin's framework on this because it clarifies the issue perfectly.
Okay, let's hear the Lemkin framework.
Lemkin points out a simple reality. If 10 autonomous AI agents can do the work of 100 human sales development reps, the enterprise buyer only needs 10 Salesforce seats, not 100. It is undeniable simple math.
That assumes a one-to-one replacement, which is rare.
Even if it's not one-to-one, the ratio shifts dramatically. The entire premise of SaaS valuations over the last 2 decades was based on human-led work. It was based on multi-tenant leverage where you charge per human accessing the database.
Right, the traditional SEEP license.
Exactly. But when the software actually does the work autonomously, the unit of value completely shifts. We are already seeing the hard data bear this out. Per-seat pricing plummeted from 21% to just 15% of SaaS adoption in the 12 months leading up to early 2026.
Okay, but what replaced it?
Meanwhile, an astonishing 83% of AI-native SaaS companies now bill on usage or outcome.
Again, you're looking at AI-native startups, not the broad enterprise landscape. Of course, startups are experimenting with new models.
But those startups are the ones capturing the hyper-growth. Look at the explosive, unprecedented growth of the companies operating on this new outcome-based model. Cursor, the AI coding assistant, hit $2 billion in annual recurring revenue in roughly 3 years.
Which is incredible execution.
That is the fastest 0 to 2 billion arc on record. It absolutely shatters the timelines of Slack, Zoom, Snowflake, the darlings of the first SaaS curve. Harvey, the legal AI, reached an $11 billion valuation in 2 years. Sierra crossed $150 million in ARR in just 7 quarters.
They're finding massive product market fit, I agree.
And none of them are selling traditional seats. They are selling resolved work. I want to replace the cliche we hear all the time in business. People always say, selling SaaS is like selling shovels during a gold rush. It's an awful, tired metaphor.
I've always hated that metaphor.
Let's look at it differently. Selling traditional sauce was like renting someone a commercial kitchen. You gave them the ovens, the prep space, the walk-in fridge, but the customer still had to hire the chefs, buy the raw ingredients, and actually cook the food.
Right, you just provided the infrastructure.
Exactly. The margins were 80% because the software company didn't buy the ingredients or pay the chefs. The new AI native model isn't renting out the kitchen, it is acting as a full-service catering company. You are delivering the finished meal to the table.
Okay, I see where you're going with this.
The margins fundamentally change because the input costs, the compute ingredients, and the AI chefs are now sitting entirely on your balance sheet. When you are a catering company, you do not charge a flat monthly access fee to your kitchen. You charge per meal delivered. You charge for the outcome.
That is an excellent analogy. The commercial kitchen versus the catering company. It highlights exactly what is changing on the vendor side. But I think you are severely underestimating the psychology on the buyer side.
The buyer just wants the meal.
I'm not ignoring the success of Cursor or Harvey. Their growth is spectacular. But we have to be extremely precise about what they are actually proving. Yes, 83% of AI-native SaaS bills on usage or outcome, but you have to look at the broader enterprise landscape.
What are the legacy enterprises doing then?
Why have hybrid pricing models, not pure outcome but hybrid, reached 41% adoption? Because pure outcome-based pricing is absolutely terrifying for a Fortune 500 chief financial officer.
Wait, why terrifying? If the catering company delivers the meals cheaper than running your own kitchen, why wouldn't the CFO love it?
Because enterprises require guaranteed predictability in their software spend above almost all other metrics. Let's walk through a realistic corporate budgeting cycle. A Fortune 500 CFO starts planning their 2027 budget in August of 2026.
Sure, the annual planning cycle.
They need to allocate funds across 40 different departments. IT gets a bucket, marketing gets a bucket, HR gets a bucket. If you walk into that CFO's office and say, we are going to charge you based on the successful outcomes our AI generates this quarter. So if it generates 10,000 successful marketing campaigns, your bill will be X. But if it generates 50,000, your bill will be 5X.
Their bill scales with the value they receive.
But their immediate response is going to be, I have absolutely no idea how to budget for that. Corporate budgeting fundamentally relies on fixed costs or at least highly predictable narrow bands of variable cost. If the IT software budget is entirely variable based on unpredictable AI outcomes, the CFO has no way to lock in departmental allocations. The variance is too high.
I think that fundamentally underestimates how ruthlessly enterprises will chase efficiency when their own margins are on the line. If it saves them headcount, they'll figure out the budgeting.
It's not about ignoring efficiency, it's about governance. Furthermore, the catering analogy breaks down when you consider the reality of enterprise infrastructure and risk management. They don't just want the finished meal.
What else do they want?
They want to know the kitchen meets health codes. They want a warranty on the ingredients. They want compliance reporting on how the food was prepared. Pure outcome pricing sounds incredibly elegant in theory, pay only for what works. But in practice, defining an outcome is a massive point of friction.
Give me an example.
Let's take your Harvey example in the legal space. If an AI agent drafts a 50-page legal brief, but a senior partner at the law firm has to spend an hour reviewing it, editing 3 paragraphs and verifying the citations, whose outcome was that? Was it the AI's outcome or the partner's?
It's a joint outcome, but the AI did 90% of the heavy lifting.
But how do you price the partial resolution of a complex task? Does the software vendor get 80% of the outcome fee and the firm keeps 20%? That friction, the sheer difficulty of defining what constitutes a resolved task, is exactly why hybrid models are dominating the transition.
So you're saying they just bolt a usage fee onto a subscription?
Exactly. You charge a base subscription for access to the platform, the data compliance, the security infrastructure, the commercial kitchen, to use your metaphor, and then you have a variable usage tier on top of that for the compute-heavy agentic tasks, the actual catering.
Which protects their downside.
That preserves the software company's baseline predictable revenue. It gives the CFO a predictable floor for their budget, while still capturing the upside of increased AI usage. The subscription isn't dead, it's just evolving to become the access and compliance fee, rather than the entirety of the bill. B2B buyers won't completely abandon subscription models because it breaks their internal financial planning.
Well, if it were just a simple, elegant transition to a hybrid access fee, as you suggest, we wouldn't be seeing the most sophisticated, ruthless capital in the world reacting the way it currently is.
You mean the private equity firms?
Yes. If you want to know the absolute truth about where an industry is heading, you don't listen to the tech pundits, and you don't even listen to the CEOs trying to protect their stock prices. You look at the ultimate truth tellers, the capital markets and private equity.
Okay, let's look at them.
The capital reallocation happening right now is the cleanest, most unvarnished signal we have. Let's look closely at Thoma Bravo and Vista Equity Partners. These are the absolute titans of software buyout. Together, they've deployed over $120 billion in software buyouts since 2019.
They're massive players, absolutely.
In 2025 alone, Thoma Bravo completed 4 massive platform SaaS acquisitions. And that includes the stunning $12.3 billion take private of Dayforce, a massive human capital management software company.
Right, the Dayforce deal was huge.
You have to ask yourself why take private deal flow right now is the highest it has been since the peak of the zero interest rate phenomenon in 2021.
Because valuations are depressed and interest rates stabilized. It's a macroeconomic play.
It is not just a macroeconomic play. Private equity firms are not stepping in simply because they think this is a cyclical recovery and they are just waiting to flip the assets. They are explicitly buying these legacy SaaS assets at depressed 6.4x multiples because they know the underlying operating model has to be completely recut.
I disagree on the motive.
They take them private, pulling them away from the punitive scrutiny of the public markets precisely to tear down that 80 margin infrastructure. They rebuild them as high variable cost AI delivery models, and they plan to hold them through this chaotic second curve. They are literally underwriting the structural reset with billions of dollars.
But a public CEO could introduce a hybrid tier.
Exactly. If this were just a matter of introducing a hybrid pricing tier, a public CEO could do that. The fact that they have to be taken private to execute this shift proves how fundamentally destructive the transition is to the traditional financial profile.
I'm sorry, but I just don't buy that interpretation of private equity behavior. Let me tell you why.
Go ahead.
Private equity taking companies private at 6.4x multiples is classic, textbook bottom fishing. It is not necessarily proof of a grand structural AI reset. It is proof that public markets overcorrected during a period of macroeconomic digestion and smart capital took advantage of the discount.
You don't spend $12 billion just to bottom fish.
We have to look at the DNA of private equity. PE firms love traditional SaaS. They absolutely adore the predictable cash flows, the high gross retention rates, and those exact 80% gross margins we are debating. They are buying the dip.
But what do they do once they own it?
What does a firm like Thoma Bravo actually do when they take a company private? They trim the fat. They look at bloated headcount, excessive sales and marketing spend, vanity R&D projects, and they ruthlessly optimize the cash flow.
That's the old playbook.
It's the playbook that works. They are not buying a stable, incredibly predictable HR software company like Dayforce to fundamentally reinvent it into a highly volatile, high variable cost AI research lab. That is the exact opposite of the private equity risk profile.
Wait, why is it the opposite?
Because PE relies on debt to finance these buyouts. You cannot service heavy debt loads with unpredictable, highly variable outcome-based revenue. You need steady, recurring cash flow. They are buying these assets to squeeze efficiency out of the existing SaaS model, precisely because they believe the traditional model still generates massive, reliable cash.
But that historical view of PE behavior directly contradicts the actual strategic reality these acquired companies face behind closed doors.
How so?
The private equity trade right now, as documented by multiple industry analyses in 2026, is explicitly to, and I quote, buy the asset at a depressed multiple, recut it to the new operating model in private, and hold it through the curve.
Holding it through the curve just means waiting for the market to recover.
No, the reason they absolutely have to do this in private is something we call roadmap theater. The public markets are actively, viciously penalizing companies that try to manage this transition in plain sight.
Okay, tell me about roadmap theater.
Let's say you are the CEO of a publicly traded mid-market SaaS company. If you stand up on your quarterly earnings call and speak the truth, if you say, we are transitioning from per-seat to outcome-based pricing, our gross margins will drop by 15 points over the next year, and our revenue will be unpredictable for the next 4 quarters as we align with AI value delivery, what happens?
Your stock gets absolutely hammered.
Hammered. Wall Street demands quarter-over-quarter predictability. So what do public CEOs do instead? They engage in roadmap theater. They add a generic OpenAI chatbot to the corner of the screen, they launch a summarization tool that nobody really uses, and they call themselves AI native in their press releases.
All while trying to protect the margins.
Exactly, all while desperately trying to protect their 80% margins. Investors see right through this now. They treat standard AI roadmaps as pure theater, unless the company explicitly shows how they are fixing the underlying AI economics. Private equity provides the darkroom necessary to develop the actual film of this new business model without Wall Street exposing it to the light and destroying the valuation too early.
Look, I agree that public markets are punishing uncertainty, and I wholeheartedly agree that AI roadmap theater is a very real, very dangerous phenomenon.
It's rampant right now.
Throwing an API wrapper on a legacy relational database and calling it AI native is a strategy that worked for about 6 months back in 2023. But institutional investors absolutely see right through it now. However, I still maintain that the fundamental restructuring you are talking about is exaggerated.
Abandoning the seat?
Yes, abandoning the seat entirely, happily accepting 60% margins as the new normal. That is not the primary thesis of these multi-billion-dollar buyouts. Private equity might be funding the transition, yes, but they are doing so to protect the core recurring revenue engine, not to blow it up and start from scratch.
I think blowing it up is the only way to save it.
Which really brings us to the operational reality inside these companies. Whether a company is public, venture-backed, or owned by private equity, the board of directors has to actually govern this transition. And asking a CEO to completely tear down a working go-to-market engine is incredibly dangerous.
It is undeniably dangerous, yes. But failing to do so is fatal. This is why the board agenda for the second growth curve is so radically different from the first.
How different are we talking?
Night and day. For 20 years, boards just asked, how fast can you acquire logos and what is your net revenue retention? Now there are 5 specific existential strategic choices sitting on the desk for any software board. And crucially, none of them are simple product decisions.
They have to be somewhat product-related, don't they?
No, it's not about what features to build. It's about the underlying economic scaffolding of the entire company. Let's walk through them, because this is where the survival of these companies is actually decided.
Okay, let's hear the 5 choices.
First, the board has to decide exactly where the unit of value sits. Is it the seat? Is it usage? Is it an outcome? Or is it a hybrid? And they must reprice to it deliberately. They have to underwrite the gross margin implication of that choice before the next renewal cycle hits.
That's a massive shift to execute in one cycle.
You cannot wait for the customer to ask for a discount because they are replacing 20 of your seats with one AI agent. Second, they have to completely recut the operating model targets to a 60 to 70-point gross margin world. You have to tell your head of sales that the commission structure is changing. You have to tell your CMO that the acquisition budget is halved.
The executives are going to fight that tooth and nail.
Oh, absolutely. Third, and this is where most legacy companies fail spectacularly, they must sequence the reset in the exact right order. Pricing first, then go-to-market strategy, then product boundaries.
Pricing first.
Before the product is even built? Exactly. Most boards do this completely backwards.
They greenlight a massive product change, the engineering team spends 8 months building a brilliant autonomous agent, they ship it, and then suddenly the finance team discovers that their legacy pricing model can't support the sheer compute costs of the agent they just built.
They bleed cash on every interaction.
Precisely. Fourth, the board needs to replace that standard theatrical AI roadmap review with a rigorous AI economics review. They need to be tracking AI-adjusted gross margins on a weekly basis. And finally, the fifth step, they must identify the single AI bet that resets the curve, rather than spreading capital thinly across a backlog of minor features.
Let's focus on that sequencing, because that is where the rubber meets the road and where I see massive operational risk that could literally bankrupt a perfectly healthy company.
You think changing pricing first is a mistake?
I think it's suicidal. You are advocating that a board should force a CEO to change pricing first before the product boundaries or capabilities are even fully established.
Because you have to know what you can afford to build.
That is asking a company to walk up to its largest, most important enterprise customers who are already jittery about the macroeconomic environment, inflation, and their own IT budgets, and tell them, we are entirely changing how we bill you. And it's going to be based on outcomes you don't fully understand yet for a product we are still finalizing.
Well, if you frame it like that, sure, it sounds bad.
That is exactly how you blow up a working go-to-market engine and trigger massive, uncontrollable churn. The gradual integration of AI features making 5 measured, smaller bets rather than one existential single bet is a much safer fiduciary path for a board.
Safer in the short term, maybe?
Safer in the long term, too. It allows the company to test customer appetite. It allows the engineering team to gather real-world data on actual compute costs in production rather than in some theoretical sandbox. And it allows the finance team to transition the billing model slowly via those hybrid tiers we discussed without alienating the legacy customer base that is currently keeping the lights on and paying the payroll.
It sounds practical, but
A complete, immediate business model reset might sound great in a Harvard Business Review strategy essay, but in the trenches of actual enterprise software, it causes massive, unnecessary disruption.
I see the appeal of that logic, and I understand why a risk-averse board would gravitate toward it, but let me give you a completely different perspective. Gradualism is exactly what gets a legacy software company killed when a paradigm shifts this violently.
Why is gradualism fatal?
Because we are not talking about moving from desktop software to web apps. We are talking about the complete collapse of human-led workflows. When you are moving from a first curve to a second curve, the fundamental rules of physics change. If you try to spread your capital across 5 different incremental feature bets just to appease your legacy customers, you are just funding a slow, comfortable decline.
I wouldn't call it a decline. I'd call it an evolution.
Let's look at the companies that are actually winning the second curve right now. Look at what Salesforce did with Agentforce. They didn't slowly roll out 5 minor features over 3 years. They didn't just add a generic chatbot to the bottom right corner of the CRM.
No, they certainly didn't.
They concentrated immense capital and engineering resources behind one massive model-level workflow collapse move. They rebuilt the core of how the system executes tasks.
And they took a massive risk doing it.
But look at the payoff. What happened? Agentforce reached $550 million in ARR and 330% growth in a matter of months. They explicitly targeted the collapse of the workflow. They didn't sell it as software that helps your reps. They heavily marketed the autonomous resolution of tasks.
And they priced it accordingly?
Exactly. They took the single bet and they aligned their pricing directly to the value of that resolved task. The boards that demand a slow, gradual feature integration are exactly the ones engaged in the roadmap theater we discussed earlier. They are signaling motion to their investors without actually shifting the location of value capture.
But Salesforce can afford to do that.
The only question a board should be asking a CEO right now is, what is our AI-native business model? And which line of the P&L does it move first? Managing the company as if the year is 2021, and they will be crushed by startups that have no legacy margins to protect.
I will certainly concede that Salesforce's execution with Agentforce has been undeniably impressive, and it proved that at least some segments of the market are ready for autonomous agents. But Salesforce is an absolute anomaly. They are the 800-pound gorilla of enterprise software.
They set the tone for the market, though.
They have the massive balance sheet, the deep customer relationships, and the entrenched market power to force a new paradigm onto their ecosystem. If Salesforce changes their pricing, the ecosystem adapts.
Which proves my point.
For the vast majority of the B2B software market, the mid-market players, the specialized vertical SaaS companies, playing bet the company on a single workflow collapse is wildly irresponsible. The reason I advocate for a measured, deliberate approach is that the underlying economics, specifically the cost of compute, the power grid constraints, and the hardware supply chain are still settling.
They might be settling, but they're settling at a higher baseline.
We're in the middle of a massive, unprecedented hardware supercycle. As specialized silicon comes online from competitors to NVIDIA, and as model architectures move away from brute force transformers to more efficient state-space models or whatever the next breakthrough is, the variable cost of delivering these outcomes is going to plummet further.
But not back to zero.
A board that panics today, tears down their 80 margin structure, and transitions entirely to a highly variable outcome model might find 2 years from now that they destroyed a perfectly good recurring revenue machine just before the underlying costs drop back to historical norms. The AI economics review you mentioned is crucial, yes. Boards absolutely need to understand their unit economics. But that review should lead to intelligent optimization, not necessarily a total scorched earth teardown.
The fatal flaw with waiting for the economics to settle is that your customers simply will not wait with you. While a legacy CEO is sitting in board meetings waiting for compute costs to drop so they can protect their historical 80% margin, a startup like Cursor or Sierra is already in the market.
Startups always move faster, yes.
And they are operating happily at a 65% margin, and they are stealing the legacy company's clients by offering outcome-based pricing that perfectly aligns with the buyer's new expectations. The first curve of SaaS rewarded leverage in a high-margin distribution model. It was all about how cheaply you could distribute the software over the cloud.
That was the game, yes.
But this second curve rewards economic quality in a high variable cost delivery model. It is fundamentally a different shape. It requires a different scoreboard, a different incentive structure for sales teams, and a completely different operating playbook from the CEO down to the junior engineers.
I think we're agreeing on the need for change, just not the severity.
We have to look at this transition honestly, without nostalgia for the easy money of the last decade. The 80% margin world built entirely on per-seat pricing for human workers is obsolete. It has been permanently replaced by a reality where inference drives a fundamentally higher variable cost and where the enterprise buyer is only willing to pay for resolved work, not just access to a digital workspace.
Obsolete is a strong word, but I hear your perspective.
The companies that will win the next decade of software simply will not look, act, or scale like the companies that won the last one.
Well, we certainly agree that the shape of the software industry is evolving rapidly, and that AI is undeniably the fastest growing segment by far in enterprise software. The capabilities we are seeing today would have seemed like science fiction 5 years ago.
Absolutely.
But I maintain my summary view of the underlying business mechanics. The economics are still deeply in flux. With inference costs continuing to fall rapidly, orders of magnitude in just a few short years, driven by the most brilliant engineering minds on the planet, this current margin compression is much more likely to prove itself a temporary growing pain rather than a permanent structural ceiling.
I guess we'll see if the engineers can outpace the demand.
The ingenuity of the engineering community will inevitably optimize the delivery of AI, just as they optimize the delivery of cloud computing, mobile data, and every preceding technological wave. While the billing mechanics will undoubtedly become more flexible, incorporating usage and hybrid tiers to account for compute-heavy tasks, the fundamental desire of enterprises to buy reliable, predictable, multi-tenant software is not going away.
CFOs love their predictability.
CFOs will always demand budget predictability. The death of SaaS has been greatly exaggerated. It is simply adapting, as it always has, to a new input cost.
We can both agree, however, on one fundamental truth that emerged from this debate. AI has permanently shifted the core unit of value in enterprise software.
Yes, that is undeniable.
Whether you believe the margins will recover or not, we have moved definitively from selling access to a tool to selling the resolved work itself. The era of easy, predictable growth built on simple multi-tenant leverage, where you could double your revenue just by hiring more sales reps, is definitively over.
On that, we are entirely aligned. The unit of value has fundamentally shifted from the shovel to the hole in the ground. The days of simply counting human heartbeats to calculate your annual recurring revenue are behind us, and that requires a higher caliber of engineering and product strategy across the board.
And that leaves us with profound questions about the future of this $1.44 trillion market. There's so much more to explore regarding the shifting dynamics of capital reallocation, the intricacies of these new outcome pricing models, and how public markets will ultimately value these high variable cost businesses over the next 5 years.
There is definitely a lot more to cover on this topic.
It ultimately leaves you, the listener, to determine whether the B2B SaaS model is undergoing a permanent, irreversible structural reset or simply a chaotic but ultimately stabilizing evolution. Thank you for joining us on this deep dive. Before we go, just remember the next time you look at the software landscape or evaluate a vendor, ask yourself, are they just renting out an empty commercial kitchen or are they actually running the catering company? Until next time.